So what happens if mortgage interest rates rise, and how do we protect ourselves against that as investors? YouTube, welcome back to another video. Today's video is packed with information, so make sure you stay tuned until the end. Investing is all about the long game, and yet some of you don't even watch my videos until the end. So I'm watching you. Make sure you stay tuned. So first of all, let's talk about what are interest rates. An interest rate is usually an amount or a percentage that is charged for the borrowing or the lending of money. So in terms of banks, what they normally do is charge a percentage of interest when someone is borrowing their money, or they'll actually pay a percentage interest rate for someone that is saving money within their bank. So that's what an interest rate is in very simplified form. But now let's take a look at the history of interest rates. So over the last couple of years, we have been at an all-time low. If we take a look at this graph that I put up in front of me, we can actually see that back in the early 90s, interest rates hit a huge whopping 15%. And that was just the base rate, meaning that if you had a tracker mortgage, you'd have been paying the 15% plus whatever your mortgage was at the time, which might have been an additional 2 or 3%. Now, as you can see from the graph, things have gradually over the years got better and better, lower and lower. And we of course have had a phenomenal couple of years in terms of interest rate, which means it's one of the most perfect times to lock in a nice 2, 5 or 10 year fixed deal. And I say that because at some point, the likelihood is that the interest rates will rise from here over the upcoming years. And in this video, we're going to talk about the reasons why and how you can hedge against that happening. But just before we go any further, a quick message from today's sponsor, the Zeus app. Estate agents, listen in. You need to join the Zeus app. This is a virtual valuation tool for sales and lettings. Prospective vendors and landlords come onto the app and they upload their property information. You can then review it and give your opinion on the value and put forward your proposed fees. Hundreds of estate agents are already using the Zeus app and they are winning valuable business. So join today or email Nick using the information in the description below. So back to today's topic, I think it's really important to straight away cover that there are two main types of mortgage products that you can get. The first one being probably the most commonly used, which is a fixed rate interest rate. And that means that you are locking in a certain interest rate with the bank for a set period of time. So although the mortgage term might be over 25 or 30 years as an overall term, the actual mortgage product that you are agreeing to is probably going to be 2 years, 5 years, or 10 years. And you might agree for buying a buy-to-let in a limited company with 75% loan to value, you might agree a 3% interest rate for 5 years, for example. The other type is a variable mortgage product, which the most common type is a tracker rate, and the tracker rate follows the base rate. So if the base rate is 0.25, like it is currently, then it will be 0.25 plus your agreed rate, which if that's 2%, your total is 2.25%. But of course, if the base rate suddenly shoots up to 2%, then all of a sudden your overall is 4%. So the tracker rate basically falls in line with what's going on at the Bank of England and the base rate. And it's also important just to add that when you get to the end of that term, things might have changed. Banks are constantly reviewing what's going on within the market, and they are within their right to increase in line with the market as well. So that means if you locked in a 3% deal over 5 years and you get to the end of that 5 years and the new rates are 5 or 6%, you have no choice but to pick a product that's on the market. Now, the other way to look at interest rates and how you can get them down slightly is loan to value. Of course, when you're buying a residential property, things are quite different. You're most commonly putting down, 10% or 20%, and they're quite favorable rates because you're buying this as your own home, you're buying this within your personal name. Now, when it comes to buy-to-let, whether that's in your own name or whether that's in a limited company, you're usually paying a slightly higher interest rate, particularly if you are doing interest-only mortgages. The usual and most common thing to do is put down a 25% deposit and have a 75% loan to value mortgage. But of course, if you put down more money as a deposit and you reduce the bank's risk and say therefore have a loan to value of 60% or 50%, then of course you're bringing that rate down because there's less risk for the bank and they therefore charge you less interest on that rate. So now let's cover another huge factor when it comes to rising interest rates, and that is our good friend, inflation. Now, inflation has reportedly, just this week, risen to a massive 5.4%, which is the highest rate it's been within the last 30 years. And these days, inflation doesn't even account for rising food costs, rising petrol costs, and rising energy rates. So really, what we're saying is inflation is probably above that 5.4%. Now, it's not surprising considering, we had a bit of a market wobble the last couple of years, and therefore the government introduced new stimulus into the market, also known as quantitative easing, where they're producing and printing more money. And as a result of printing more money, the house prices go up, which is fantastic. The rents go up, which is also fantastic. And also other asset classes go up in value as well. Now, at the point in time at which we see large and dramatic increases in inflation, usually the government or the banks try to step in and control it and bring that down a bit. And the way they do that is by increasing interest rates, which is why this is an incredibly important subject right now, and is perhaps why we should be considering it, whether it's the upcoming months or years. We should really be thinking about it and know all about it. So now for the part you've been waiting for. How can we cover ourselves against rising interest rates? In the past, I've been criticized of two main points. First of all, that I am perhaps too focused on the ROI, the return on investment. And the other one being perhaps I don't take enough risks. I'm too structured by numbers. And for me, my numbers are, if it's turnkey with all costs factored in, I have to try and hit at least 15% ROI or above. If it's a buy, refurbish, refinance deal, I need to hit at least 25% ROI and above once I've refinanced that property. So perhaps I've, in the past and now still, am perhaps too focused on those numbers, and people have said that maybe I don't take enough risks, maybe I need to jump and do more deals. But there is a good reason as to why I focus on those 2 points so thoroughly, and that is because usually those ROI numbers mean that the property cash flows enough that if an interest rate rised, then I could cover myself. And that is also known as stress testing a property, making sure that a property will still cash flow as interest rates rise. So my answer to being cautious is running a stress test, checking that, although I'm perhaps locking in a 3% deal right now for the next 2 or 5 years, can this property still cash flow and wash its face, for want of a better word, if the interest rates rise to 4%, 6%, 8%, maybe even 10%. Earlier on, we discussed how historic highs have been up at 15% for the base rate. I don't believe they're going to get back to that point, but what if they got closer to it? What if they were at 8% or 10%? Do my properties still look after themselves, or are they starting to go negative where I actually have to put money in the business just to keep these properties afloat? But please remember, none of this video is actually financial advice. I'm just telling you what I do, sharing what I do, and hopefully you can learn something from it and take some of these and put them into action. But one of the main things that I do to hedge against these interest rate rises is the stress test. So I actually have an inbuilt stress test calculator in my spreadsheets. So when I punch in the numbers, I'm working out my return on investment, then it also tells me, listen, this property is going to function at 4, 6, 8 or 10%. And normally I would find that most deals are broken when they get to 10%, but that's quite common. And hopefully, as I've said, the interest rates won't rise above that within the upcoming decades. So to round off this video, I want to explain what I'm going to do. So going forward, I'm going to be locking in some nice, juicy, fixed interest rates. Most likely, I'll be doing 5 years. I've got a couple of ones I've just agreed to at 2 year, but I think going forward, 5-year fixed rates to make sure I lock in those good deals. And once they come up, we can see where the market is. Of course, I've just explained the stress test. I'm going to be stress testing every property. This is something that not many investors do, and it really surprises me or worries me that people aren't. And I think this is somewhere that you as a viewer should be putting your focus and attention into learning more about how you can stress test a deal and what the benefits to that are. And of course, last of all, which kind of goes hand in hand with that, is cash flow. Let's make sure a property is cash flowing and not, making £50 or £100 profit and people thinking, yeah, well, it's fine because it will go up in value. I don't believe in that. I don't think that's a very good strategy, because the minute interest rates go up, then you're going to find yourself in deep, deep waters. I really hope you've enjoyed this video. I hope it's been useful, and I hope to see you next week. Don't forget to subscribe, and until then, see you next time.